Okay, what is EIC analysis? Okay. Assalamualaikum warahmatullahi wabarakatuh. Okay, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. I am Dr. Adli. Today we'd like to continue on the lecture on the portfolio investment and management. So for today's lecture, I will be actually talking about the about the background, the basic principle, the investment policy, which we have already covered in our previous lecture. And then number two is actually how we want to construct the portfolio. Number three is actually to manage the portfolio. And number four, to protect our portfolio and also the contemporary issue that we like to discuss. All right. Okay. So basically, when we look at a bit about investment, okay, security analysis, portfolio management, purpose of portfolio management, low risk versus high risk investment, and portfolio manager's job. So I have covered this in our previous lecture, but is actually is quite refreshing if we can actually listen back to this what you call it this theoretical aspect of investment. All right, and then we look at the sixth step of portfolio management, and from here then we can actually do your assignment is actually to construct a portfolio, okay, using what you call it given capital, okay, and then you will have to construct a portfolio, probably a portfolio of 5 to 10 securities from the stock market, and then we have to look at your portfolio objective, whether you are looking at the low risk and what is it optimal, whether you are speculative, okay, whether you have a steady growth portfolio, or whether you want to have what I call it a protective portfolio securities. Okay, all right. So investment, basically traditional investment covers with security analysis, involved is estimating the merit of individual investment, whether that investment is actually worthy, okay, whether it's actually can provide you handsome return, right? So basically everybody want to invest because they want to get some additional return to their investment. And when you have return, when we talk about return, then we will also be talking about risk, right? But in the portfolio management, it deals with the construction and maintenance of collection of investments. So basically, we have 2 or 3 or more securities in our portfolio. So that's what I call it. We have to manage our portfolio. All right. Security analysis, basically a 3-step process. The analysts consider prospect for the economy given the state of the business cycle. So basically, we look at the economy as a whole first, then we look at industry, generally we look at the particular company. So we cannot just ignore the market, because market is actually one of the driving forces of the economy, and also it will also promote the growth of the company itself. And then the analysts determine which industries are likely to fare well in the forecasted economic conditions. So we have a different type of industries. We have, for example, the construction industries, technology industries, we have the plantation industries. So in that particular cycle, business cycle, which industry should we focus on? Because sometimes when we wrongly choose a different industry, then probably we will not making money because that industry is going down, right? So which is very, very important. And also the analysts choose particular companies with favored industries. So basically, when you look at a different type of companies in a different setting of we call different industries, so you want to probably look at the top performance company in that particular industry. All right. So basically, this three-step process is very simple. You can actually look from your technical analysis and also from the fundamental analysis. You can actually choose the company that you want to invest in based on this three-step process from the economy as a whole, the industry, then you look at the company. All right. So it's actually the economy, industry, and company analysis, EIC, analysis of top-down approach. Okay, a top-down approach. I will just have to see whether is there any question from the class. So basically, the three-step process are look at in the economy, and then look at the industry itself, and then you look at the company. Now, how do you want to do that in the real world? So if you want to look at the industry, for example, the economy, what you can do is you look at the stock market index. Okay, you can do this by looking at the stock market index, and then you can see whether the economy is actually moving upward or moving downward. So I would like to open we call it the chart of the Kuala Lumpur Stock Exchange. All right, so this is the Kuala Lumpur Stock Exchange. All right, so just waiting for it to be updated. Kuala Lumpur Stock Exchange, the index of 30 companies, 30 big companies in Malaysia, and these 30 companies, the index actually represent the overall market of the Bursa Malaysia companies companies in Bursa Malaysia. Why only 30 companies? Because these 30 companies is the market capitalization, which is the size is big, so it can actually represent the total market in Malaysia. All right, let's look at the Bursa Malaysia, which is the KLCI. So this is the first step, which is you look at the economy as a whole. You look at the overall market. So I just choose the market. All right, dice. Okay, this is the Kuala Lumpur Stock Exchange. All right, now if you look at the economy, okay, we are actually in a phase of rapid growth, okay, since 1998. Okay, this is from 1998, it keep on going, then we have some turbulence here, we go up again, and now we actually probably in a correction, but something that we would like to really careful is that we have actually we call it the index has breakthrough, okay, down from the moving average 50, which is not really something that we want, because if you look at here, the index is rarely break down from the MA50. We have one time here. Okay, I just go for drawing here. Okay, one time that we break here, but we managed to go up again. Okay, and then this is again. All right, one more time here. Okay, this is also one more time. Okay, we have reached the MA50. All right, and here a little bit, here and here. Right, you see, once we have a very big jump here, then we have like some crisis here. We have a crisis in 1998. We have a crisis in 2008. All right, and also we only have a small, I call it correction. Okay, here, whereby we still manage to overcome the problems, but here we have another one, which is we have reached the MA50, the moving average 50 days, which is almost like the price or the index of 2.5 months. Okay, 2.5 months. So basically, this is, we are looking at the economy. Okay, we are looking at the market. So first step is we look at the market. Okay, first step is you look at the market. All right. Well, I just, all right. So this is the first E, economic. All right, first E is economic. All right, this is the first E. Oops, sorry. Right, sorry. Okay, this is the first E. Okay, you look at the market. Okay, then you look at the for example, the industry itself. Okay, now let's look at finance. This is finance, the industry finance. So here finance is moving downward. Okay, this is finance. So you don't want to be in the industry which is going down, or probably you want to be in the industry which is going down, but you want to buy at very bottom. So you want to wait at the bottom, right? Okay, that is finance. And then you can also look at the industrial products. Okay, this is also industrial product. You can see that this is MA50. So this is also going down. So you want to buy at the lowest point here, probably here. Okay. Okay. All right. But at the moment it's still going down. That is the industrial product. Okay, and this is industrial. Okay, right, so still going down also. Right, then you have mining. Okay, this is mining industry. Okay, so I believe it's going down also. And then you have plantation, also is going down here. Plantation, properties also is facing a downturn. All right, and then this is REIT. Okay, REIT is actually this is going up. All right, technology. Okay, there is probably this is breakthrough, okay, a breakout, okay, from the previous downtrend. So now it's actually going up. Trading and services, okay, also moving downward. All right. So basically, you can see that all the industries are moving downward, okay, except for technology, okay. Probably technology is, but if you can look at it, this is still not still going down, right? So except that it's actually moving upward a bit. All right, so basically most of the industries are going down, right? So this is the second step, okay, which is I in industry. First is E, the economy. Second is industry. So if you want to be in one of the industries, let's say you want to be in finance, or you want to be in you want to cash in the, okay, let's say we use trading and services, right? In trading and services, this is like you want to buy at the bottom here, want to buy at the bottom. Okay, now it is you need to look at the best company in the trading and services. So how you want to find that? So this is very simple. So this is C, yeah? First is E, then you have I, then you have C. Okay, so for C, all right, for C, you can go to, okay, example, any stock screener. For example, I'm using iSaham here. iSaham, okay. iSaham stock screener, okay. All right, now I would like to screen for the just now um, okay, just now I would like to um, let's say in the which this one is in the trading and services. Okay, trading and services. Okay, and okay, we will stop at 11 o'clock. Okay, I will stop at 11 o'clock because I need to go afterwards. All right, so let's say we want to go for trading and services just now. Okay, where is the trading and services? All right, so all right, this one. Okay, if you look at this, all the industries, okay, all the industries are negative, all red colors. Okay, the bull sectors are this. Right, these are the bull sectors: rubber and rubber glove, aerospace, poultry and eggs, and food and beverages. All right, let's say you want to go for the trading and services. Okay, this is trading and services. You want to buy, which is the bottom, at the bottom at this industry. So basically, that is actually something that is very risk, but sometimes this is one of the strategy. You buy at bottom and then you sell at the highest point. So you want to find the best company in the trading and services. Okay, so probably you can use the screener, right? So here the screener is looking at the trading PE, Alman Z-score, FCOM, and total score. So this is one of the what you call it, screener that you can use when using what you call it iSaham. Okay, .my. All right, so you can, let's say you want to find the best one for this is actually looking at this. All right, so the highest score will be Dialog, right, followed by Yinsen, end to end, okay, on cash, and then Petronas Dagangan, and so on. All right, so if you want to focus on Dialog, then you can actually go for Dialog, or maybe you can go for Yinsen, but you have to choose whether it's actually Sharia compliant or not. Okay, that is for if you are looking at the company, the C, okay, the C for EIC just now. Okay, for the company you have to look at two. fundamental and also the technical part. Okay, the fundamental is the what you call it, uh, the strength of the company. Okay, so basically it has a very strong fundamental here, 8.8. Technical is about 4.5, and that's why you have a score of 30.3, right? So this is a we call it good company. However, the sector trend is negative. It's a red sector trend, and then this is also being invested by institution. Okay, so institution also are looking at this company. All right. So there are also a lot of things that you need to understand before you invest, right? So which is very you have to have some uh, knowledge about finance. Okay, right. So basically, these are the EIC when you do the security analysis. All right. Okay, we will actually explain it more later if we have time. Okay, and inshallah we will actually try to go in more deeper. Okay, on the analysis. All right. Okay. Now let's look at next one, portfolio management. Okay, portfolio management. Uh, the literature support the efficient market paradigm. So on a well-developed securities exchange, asset prices accurately reflect the trade-off between relative risk and the potential return of a security. Now, efforts to identify undervalued securities are fruitless. Free lunch are difficult to find. So basically, if you are looking at a well-developed securities exchange, asset prices actually is already there. It's already been all being incorporated. All the news, all the information are already being incorporated. So it's quite very difficult for us to find undervalued companies, undervalued stocks. Okay, so that is the efficient market paradigm. All right. So market efficiency and portfolio management. So basically, a properly constructed portfolio achieves a given level of expected return with the least possible risk. So you want to get the highest expected return with the lowest or the least possible risk, because you can actually maximize your return profit, okay, if you do that. So basically, portfolio managers have a duty to create the best possible collection of investment for each customer unique needs and also circumstances, because every customers have different needs. Okay, every investors have different risk tolerance, risk profile. So we have to look at their different unique and needs and also circumstances. All right. Okay. Okay. Um, so the purpose of portfolio management basically involve reducing risk rather than increasing return. So we want to reduce the risk of our investment. So that's why it involved with we call it trying to reduce the potential of losses rather than increasing our return. So that is the purpose of investment. Consider two investment, 10,000 investment, okay? Earn 10% per year for each of 10 years, okay? For each of 10 years. So basically it's low risk. Whereby if you we call it earn 9%, then you have a negative return, then 10%, 8%. So this is actually considered as high risk. They're very volatile. So basically, uh, uh, volatility is risk. Okay, so the higher the volatility, the higher the risk. Okay, so low risk and also versus high risk investment. Right, so this is low risk. The red color one is low risk. You have a very, I call it steady, okay, increasing return. As compared to this, okay, you have a dip, okay, below the average, and then you go probably have a higher return, and this is considered as high risk, right? So low risk and high risk investment, okay, will be depending on the volatility of the security itself. Okay, so basically, if one earn 10% per year for every each for each of 10 years, is actually low risk because your terminal value is 25,937. But if you have this very volatile, we call it securities in 10 years also, your terminal value is 23,642, which is lesser than the one that which is having a very constant, okay, uh, return every year. So the lower the dispersion of return, the greater the terminal value of equal investment. So if you are, we call it, investing regularly, okay, probably it will be best if you have, we call it, a security which has a lower dispersion of return. So which means that the return is not the dispersion is not that too big. So it's still growing, but it's growing in a very steady path. Then it will actually generate a higher return for you. Okay, that's why sometimes people invest in tabung haji, they invest in ASB because the ASB and tabung haji has been consistently provide a return that they can predict, and is consistent at about 6 to 7% every year. So it's actually provide you higher return as compared if you have securities. Okay, in the stock market, for example, one year you get 10%, the other year you get 5%. So it will be better to have a lower dispersion of return if you are constantly investing in that securities every month, for example, or every year. So the portfolio job manager, okay, portfolio manager's job is actually begins with a statement of investment policy which outline what will be the return requirement and also what will be the investor's risk tolerance and the constraint under which the portfolio must operate. All right. So this is the constraint. You have to set the objective of your investment policy, right? So now let's look at the 6 steps of portfolio management. First, learn the basic principle of finance. So it is actually compulsory, okay, for you if you want to have your own portfolio, or you want to become a portfolio manager, or you want to become an investor, is to learn the basic principle of finance. So this is compulsory for you because if you do not know about the basics of finance, then you will be risking your lifetime savings, right? Number 2, set the portfolio objectives. Number 3, you formulate an investment strategy. Okay. Number 4, have a game plan for portfolio revision. You have to revise. Okay. If the market change, what will you have to do, right? If the market change direction, you have to change direction, right? Don't ever, okay, we call it, try to move against the market. Okay, you cannot win against the market. Okay, so you have to go with the market. So basically, you have to have a game plan. You have to revise your portfolio from time to time. Then you have to evaluate performance, whether you are actually making money or you are not making money. You are making losses. And number 6 is to protect the portfolio when appropriate. So this is very important because I've met some of the investors. They say that, oh, you just invest your money because we want to follow Warren Buffett. Warren Buffett invests 10 years or 20 years. Okay, so what they do is that they buy a certain security. They know that the security is good. They just throw away the password to the trading platform. to the system. So this which is not really good to do, because you still need to monitor, right? Because we have the EIC just now, economic, okay, industry, and also company. You cannot only depend on the company, the C, the E, and the I, okay, must also be monitored. The E and the I, the economy and also the industry. All right. So I hope that that will be sufficient for now. Okay. Can we just we call it continue on a little bit later in the evening, because I need to do some errands I have to do at 11 o'clock in the morning. So I'll see you at probably at the evening, or maybe I will just record it. Okay, I'll just pre-record it, and hopefully that we can actually benefit from the lecture that lecture that that I've delivered just now. Um, so for the assignment, okay, for the assignment, basically, uh, students, okay, the students need to do their own portfolio. They, so they have to choose their securities, all right? Okay, their securities. So probably we'll start with the capital of 100,000. So with that 100,000, what would you like to invest by choosing certain securities? And by the end of this semester, then we will evaluate what would be your performance, okay, of your portfolio, what you have done, what you have included, what you have excluded. So these all have to be documented and to be submitted to me. So with that, thank you. Assalamualaikum warahmatullahi wabarakatuh. We'll see you in the next lecture.